Goldman Sachs sounding the alarm to its clients about the potential market fallout from the coronavirus. Goldman strategist Peter Oppenheimer writing, in his words, "We believe the greater risk is that the impact of the coronavirus on earnings may be underestimated, in current stock prices, suggesting that the risks of a correction are high." For a further look at how the virus could disrupt the rally, let's bring in Stephen Wieting, Chief Investment Strategist at Citi Private Bank. I guess you wouldn't just reject that out of hand, that analysis. In your view, though, you see the coronavirus first shock to the world economy in 2020. However, unlikely it will be a lasting turning point for what happens with global growth. That's right. Your view?
I think we were optimistic coming into the year that we were going to rebound on industrial activity, trade activity, manufacturing. You could see this in the Philly Fed numbers. That's sort of the initial conditions coming in. But China's really calling in sick for the quarter. We're going to contract China's economy in the first quarter of the year sequentially. Trade activity, disruptions, these sorts of things will be big. And what you saw out of Apple, there'll be hundreds of other companies impacted over the course of the first quarter. Now, where the virus goes from here is to be seen. But this is like a natural disaster. Getting people back to work, normalization, will get a rebound. So that's why we've had these cases in the past. None of them have led to lasting turning points in the world economy previously. And I think that you'll see a very sharp rebound from it. But our market's really smart enough now to completely look through that.
Who knows?
So far, so good, but interruptions.
Citi looked at 5 previous world health threats, and there was an average 8.2% drop in global equities, followed by a 19% gain over the next 6 months. This may not be your garden variety. It may or may not be at this point.
Well, when we've only fallen at most 3.5% on global equities, recouped it all, and then moved on our merry way as if there's no interruption here, you've got to wonder whether we've discounted not just recovery, but an uninterrupted recovery. But we're not changing medium-term views over this. But I just think be aware that we're going to have definitely problems with first quarter earnings season for anybody cross-border.
You're a nervous bull to start with. You got overweight in treasuries and gold to offset positions that you have in equity. And then also, you think maybe dividend stocks are the way to go now because the other areas, growth and others, will be more volatile and maybe the gains are already there?
Yeah, I think if you take a look at U.S. markets across the board, the dollar is surging. We're getting safe haven inflows into U.S. bonds, credit, equities all at once. Utility stocks are surging. High growth stocks are surging. So you're getting all of that. The one thing is that the more generally stable cyclical companies that grow dividends have generally fall behind in this. And probably on the way out of this, I think that they can do better.
Were you a nervous bull for most of last year, would you say, or were you just buying with both hands?
We certainly not buying with both hands. I think the middle of the year period, the trade war.
From there on.
Yeah, but we...
you had to be surprised at the series of new highs over the past...
we've had overweights in global equities, U.S. equities, ending the year, coming into the year. We're still overweight U.S. equities, global equities, underweight fixed income.
Were you watching, though, with one eyebrow raised, like, wow?
There were a couple of periods here of worry, and this is another one. But, again, our base case view here is this is a temporary shock. It's a natural disaster. If we find that infections fall, that they don't become a global issue, we get activity back in line. We've got to look back to SARS, for example. I know that there are many, many differences, the rate at which we've had fatalities, the rate of infection was very different, China's economy was smaller, all of this. But the economy in China went from 12% growth down to 3.5%, then up to 16%. This pattern, and it's the chance of this disrupting important things. I mean, look, oil demand around the world for jet fuel has probably plunged global oil demand by about 5% here and now. I think it can come back, but it must be temporary.
So, it's an election year. You didn't mention that. Will that ever become something that you need to factor into what Citi does?
I think investors have worried a little bit too much about the election generally. They can't be absolutely certain. Our base case view here is 77% of first-term incumbent presidents have won re-election. The economy is good in the United States. Unemployment is low. Inflation is low. And why should we assume any change on this?